For investing the stock, you can choose any of the sectors like energy, technology, real estate, banking, pharmaceutical, etc. When we talk about sectors, we are looking at different areas of a company where companies operate. There are several sectors like this. For example, the tech sector includes companies like Google, Facebook, and which are all about innovation and digital stuffs. Each sector can perform differently based on economic conditions. For instance, tech stock might do really well during a boom when everyone's investing in new gadgets, while consumer goods might be steadier during recession because company people still need to buy essential, right? When it comes to investing in bigger versus smaller companies, it really depends on what you're looking for. Bigger companies like those big names brands you see everywhere tend to be more stable. They usually have a solid track record, established revenue streams, and a loyal customer base. This means they might not grow as fast, but they also are less likely to crash and burn suddenly. On the flip side, smaller companies can be super exciting. They often have more room to grow, which means if they hit it big, you could see some serious returns on your investment. But so if something goes wrong, they could struggle a lot more than the big guys. It's like betting on a startup. It could be the next big thing or it could flop. So, if you are looking for a safety and steady growth, bigger companies might be the way to go. But if you are feeling adventurous and want to chase the big gains, smaller companies could be worth for a shot. Just make sure you do your research and understand what you are getting into. Next, I will give you the two options. You can decide which method you prefer. The first one, you can search for good stocks to buy. Okay, when it comes to picking stocks, it's all about doing your homework. First off, you really want to dive into the companies itself. Check out their financials like how much money they are making, their profit margin, and they have a lot of debt hanging out over them. And it's kind of like looking at report card, guys. If you want to see good grades, then make sure you understand what the company actually does. If you can't explain it to your buddy in the company of the sentence, maybe it's not the best pick. You also want to look at the management team. Okay, a solid team can really steer the ship, right? Especially the things to get rocky. Then next step is about the industry. Is it growing? Are there any cool trends happening? Sometimes a great company can struggle just because the industry is not good spot. So next talk about index fund or ETFs. Alright, so index funds are pretty cool and popular choice of a lot of investors. Basically, an index fund is a type of mutual fund or exchange traded fund that aims to match the performance of a specific market index. Okay, guys, think of it like this. Instead of trying to pick individual stocks and guess which one will do well, an index fund lets you invest in a whole bunch of company all at once. One of the biggest perks of index fund is that they usually have lower fees compared to actively managed funds because they don't require a team of managers to pick stocks. They just track the index, which make them a more cost effective option. Plus, they tend to perform pretty well over the long term, often beating those actively managed funds, especially after you factor in the fees. They are also super easy to buy and manage. You can set it and forget it, which you great if you are not into constantly checking the market. Just remember, like any investment, they come with risk, and the market can go up and down. But overall, it if you want a simple, diversified way to invest, Index fund are solid choice. Okay guys, that's it for today because all video I'm trying to finish within 5 minutes. Okay, bye all. See you with next video.